In this video, we will follow the differences between the two important entities, the stock market and the economy. Have you ever wondered how the stock market and the economy are linked? Many investors are under the impression that the stock market and the economy are the same thing. However, this misunderstanding makes them miss many opportunities. The smart investor, on the other hand, knows exactly how the stock market and economy differ, so that they can make informed decisions about where to invest their money. Hi, this is Prashant Saraf, and you are on my channel Blueprint Investments. I am on a mission to arm 1 lakh investors with the knowledge, strategies, skills, and tools to create life-changing wealth for themselves and their families. Coming back to the video, let's try to uncover some important features of both the stock market and the economy. Over the long term, the economy and the stock market move in tandem. However, over a period of few quarters to years, they can diverge meaningfully. We recently saw this divergence after COVID as the economy contracted while the stock market expanded. As the stock market is supposed to represent how the economy is doing, this has confused many investors. We can try to understand why this happened by looking at the stock market and the economy in some detail. The stock market is denoted by the Sensex, the Nifty, or some broader index like the Nifty Midcap Index. There are different types of participants in the stock market, like domestic retail investors, foreign institutional investors, as well as the domestic institutional investors. These investors can have different views of the market based on their own peculiar interests as well as their investment horizon. For instance, foreign institutional investors were pulling out money from the Indian markets till recently as the dollar was strengthening and they were in a risk-off mode. While domestic retail investors continued to put money in the markets through mutual fund SIPs as well as fresh purchases. Like any other market, the share market goes up when the demand from different participants is more than the supply. So, during COVID, the demand from investors went up as they expected the Indian economy to do well. This is because they correctly anticipated that COVID was a temporary blip and the economy still had a lot of room to grow. The economy is a much broader term than the stock market, as it takes into account all the goods and services produced in the economy. The three components of the economy are goods and services, government spending, and investment and net exports. Unlike the stock market, which only covers publicly listed companies, the economy measures all aspects of the country like unemployment, inflation, housing starts, and many others. Let's understand unemployment first. Unemployment can be calculated based on surveys for both rural and urban areas. These surveys count the number of workers who are ready to work at prevailing wages but who are not able to get a job. The main reasons for this are a high population of workers and a lack of appropriate education and skills. Let's understand inflation next. Inflation is a general rise in the price of goods and services, and it affects the purchasing power of individuals. Inflation can be measured at the wholesale level or at the retail level. For instance, the wholesale inflation number for October 2022 was 8.4%, while the retail inflation number was at 6.7%. So as we can see, the retail inflation is currently lower than the wholesale inflation. This is because producers have been reluctant to increase prices even as their raw material costs have gone up. However, there are high chances that as wholesale prices of raw materials cool, producers may not fully pass on the price reductions as they would like to recoup part of the lost margins in the previous few quarters. The stock market is an easily accessible gauge for the economy. However, the stock market only includes public companies which are listed, so many small companies are not covered. It should be noted that 93% of the workers in India are employed by companies which are in the unorganized sector. An economy's numbers like unemployment and inflation, on the other hand, affect everyone. So, an economy's numbers are a more complete picture of how most people are doing. In other words, low unemployment and low inflation are better barometers of health than the stock index levels. That doesn't mean it doesn't matter. Stocks have both indirect as well as direct effects on the economy. For example, a company whose stock price has dropped might find that there is no appetite to fund speculative bets when the stock market has tanked. This is an example of a direct effect. An indirect effect of the stock market going down is investors putting off purchases because they feel poorer. So an investor may stall his home renovation project because the market is down. When the stock market is up, on the other hand, companies are able to raise capital and hire employees, and so they find it easier to grow their business. The stock market going up can also make those who invest in it feel wealthier and consume more luxuries like cars, etc. So as you can see, a strong stock market can boost the economy, while a weak one can cause it to become sluggish. At the same time, the stock market is also hugely impacted by the economy. Investors are always influenced in their purchase and sell decisions by observing the economy. They look at factors like interest rate, fiscal policy, employment, housing starts, etc. to understand where the economy is heading next. So, the stock market in a way tries to anticipate where the economy will be in the future, and investors reflect this expectation by moving prices up or down. Stock markets are forward-looking and stocks go up based on changes in future expectations, as current conditions are already fully embedded in the price. When we look at the data of the economy, we are talking about economic output, employment, etc. as they have already occurred. In other words, the stock market and the economy are constantly influencing each other. So this is the reason that while the economy is in the dumps, the stock market rises on future expectations being good. So the takeaway from all this is not to ignore the information given by either the economy or the stock market, but to look at both in a calibrated approach. In other words, since both entities are complex and are only giving you part of the information, a balanced approach is better to understand the future prospects than by just looking at one indicator. This concludes our video on the stock market and the economy.